Start with a simple definition. An index fund is a type of investment fund, either a mutual fund or an exchange-traded fund, that aims to replicate the performance of a specific market index, like the S&P 500 or the Nasdaq Composite, by holding the same or a representative sample of the securities in that index. In plain terms, instead of trying to pick winners and time the market, an index fund passively tracks a defined list of stocks or bonds so your investment moves in step with the broader market segment the index represents. Why does that matter? Because index funds offer a straightforward, low-cost way to achieve broad market exposure and build diversified portfolios without the time, expertise, or fees associated with active stock picking. Over decades, many actively managed funds have failed to consistently beat their benchmarks after fees. Index funds accept market returns but strip away much of the cost and risk of human error. For most individual investors, that trade-off, steady market returns with low costs, makes index funds one of the most practical and effective tools for long-term wealth building. Concrete examples help make this real. First, the Vanguard 500 Index Fund mirrors the S&P 500, giving investors proportional ownership in 500 of the largest U.S. companies. It's often used as a core holding for retirement accounts. Second, a total bond market index fund, like the iShares Core U.S. Aggregate Bond ETF, tracks a broad mix of government and corporate bonds, offering predictable income and diversification against stock market volatility. Other specialized examples include international index funds that track foreign markets and sector-specific index funds focusing on technology or healthcare. Many financial experts endorse index investing for its cost efficiency and reliability. Nobel Prize-winning economist William F. Sharpe and investor John Bogle, founder of Vanguard, argued that minimizing fees and capturing market returns is the most reliable path for most investors. Yet there are alternative viewpoints. Critics argue that passive ownership can inflate asset prices, reduce market discipline, or be less effective in inefficient markets where active managers might find opportunities. Potential challenges include tracking error, tax inefficiencies for some fund structures, and the emotional difficulty of accepting market average returns during hot bull markets. Despite these caveats, index funds connect directly to other aspects of investing: asset allocation, risk management, tax planning, and retirement strategy, making them foundational building blocks for most modern portfolios. Index funds are investment funds designed to mirror the performance of a specific market benchmark, such as the S&P 500 or the total stock market. At their core, they operate by holding the same securities, and often in the same proportions, as the index they follow. Rather than selecting individual stocks or timing the market, an index fund passively replicates the benchmark's composition so investors capture the market's overall returns with minimal active decision-making. This passive management model is significant because it simplifies investing and reduces costs. Active managers hire analysts, trade frequently, and attempt to outperform a benchmark, which incurs higher management fees and trading expenses. Index funds, by contrast, require less research and fewer trades, which lowers expense ratios. Over time, lower fees and reduced turnover can materially improve an investor's net returns, especially when compounded across decades. Two clear examples illustrate the approach. A large-cap S&P 500 index fund will buy shares in the 500 companies that comprise the S&P 500, maintaining weights that reflect each company's market capitalization. If a company's market cap grows, the fund gradually increases that position. If it drops out of the index, the fund sells it. A total stock market index fund takes a broader route, holding thousands of U.S. stocks across market caps to represent the entire domestic equity market. Both funds aim to track, not beat, their benchmarks. Real-world applications extend to retirement accounts and core satellite portfolios. Many 401 plans offer index fund options for long-term retirement savings because they provide broad diversification and predictable costs. Financial advisors also use index funds as the core of portfolios, combining them with targeted active strategies like specialized bond funds or small-cap active managers for potential extra return or risk management. There are supporting opinions from Nobel laureate economists and investment professionals who argue that passive indexing is a rational choice for most investors, citing empirical studies showing that most active managers fail to outperform after fees. Critics, however, raise challenges. Passive funds can't avoid overvalued securities. They may exacerbate market concentration in large-cap winners, and they remove some capital allocation signals that active investors provide. Additionally, tracking error and tax inefficiencies can occur if a fund doesn't perfectly replicate its index. Understanding how index funds work connects directly to broader investment decisions: asset allocation, fee awareness, and risk tolerance. Knowing that index funds track benchmarks passively helps investors choose appropriate funds, mix them into a diversified portfolio, and set realistic expectations for market returns. Index funds come in several familiar forms, and understanding the differences matters for how you invest, how much you pay, and how hands-on you want to be. At the broadest level, you'll hear about index mutual funds, exchange-traded funds, or ETFs, and more specialized or targeted indexes that track niches like small caps, dividends, or environmental themes. Each type is the same basic idea: passive, rules-based tracking of a market, but they behave differently in practice. An index mutual fund is a pooled investment that seeks to replicate the performance of a specific index, such as the S&P 500. You buy and sell shares directly through the fund company, often at the end-of-day net asset value. The significance here is simplicity: automatic reinvestment of dividends, straightforward dollar-cost averaging with regular contributions, and typically low expense ratios compared to active mutual funds. Real-world examples include Vanguard 500 Index Fund and Fidelity 500 Index Fund. A common challenge is minimum investment requirements and less intraday flexibility compared with ETFs. Exchange-traded funds combine the index tracking approach with stock-like trading. ETFs trade on exchanges throughout the day, so you can buy, sell, and use limit orders like individual stocks. Popular examples include the SPDR S&P 500 ETF and iShares Core S&P 500 ETF. ETFs often have even lower expense ratios and tax efficiency advantages because of their creation-redemption mechanism, which can reduce capital gains distributions. On the other hand, investors need to consider bid-ask spreads and possible brokerage commissions or platform fees, though many brokerages now offer commission-free ETF trading. Targeted or specialized index funds track narrower slices of the market, value stocks, small-cap companies, dividend-paying equities, international markets, or ESG and sustainability themes. These targeted indexes let you tilt a portfolio toward specific goals or views, such as the Vanguard Small Cap Index Fund or iShares MSCI Emerging Markets ETF. They're useful for diversification and expressing tactical preferences, but the trade-off is concentration risk and sometimes higher fees or lower liquidity. Some investors and advisors recommend a core satellite approach, Use broad index mutual funds or ETFs as the low-cost core and add targeted index funds for specific exposures. Critics caution that overcomplicating with many niche indexes can erode diversification and increase costs. Ultimately, choosing among mutual funds, ETFs, and targeted index funds depends on your trading style, tax considerations, cost sensitivity, and investment goals. And all of these choices tie back to the fundamental appeal of index investing: disciplined, low-cost market exposure. Index funds are powerful because they combine three practical advantages that matter to everyday investors: low cost, broad diversification, and tax efficiency. First, low cost means index funds are designed to track a market benchmark rather than pay managers to pick stocks. That passive approach eliminates expensive research, frequent trading, and high management fees. Lower fees directly boost returns over time. For example, a fund charging 0.05% annual fees instead of 1% keeps far more of your gains compounding year after year. Another example is retirement accounts. Choosing a low-cost index fund for an IRA or 401 can translate into tens of thousands of dollars more at retirement compared with higher-fee active funds. Many financial experts, including Nobel laureates in economics, argue that minimizing costs is one of the few reliable ways an investor can improve long-term performance. Second, diversification means index funds spread risk across many securities by design. A single S&P 500 index fund holds hundreds of large-cap U.S. companies, so the poor performance of one firm has limited impact on the whole. International index funds add exposure to companies around the world, diluting country-specific or sector-specific risks. For instance, a total stock market index fund covers small, mid, and large-cap stocks, smoothing volatility that comes from any single segment. Real-world applications include using a broad stock index fund as the core of a portfolio, while adding a bond index fund for stability, or pairing a U.S. index fund with an international index fund for global exposure. Third, tax efficiency comes from lower turnover inherent in index funds. Because they only rebalance to match an index, they buy and sell far less frequently than active funds. That means fewer taxable events, less capital gains distributions hitting shareholders. Tax-managed index funds and ETFs often use in-kind transfers to further reduce taxable gains. For taxable brokerage accounts, this can be a meaningful advantage. You keep more after-tax returns without having to engage in complex tax loss harvesting yourself. There are trade-offs and alternative viewpoints. Critics point out that index funds replicate market weaknesses, and extreme concentration in a few large firms can reduce diversification benefits. Additionally, passivity means you're committed to the market's losses in downturns. Still, when connected with asset allocation, periodic rebalancing, and a long-term plan, the low-cost, broad diversification, and tax efficiency of index funds make them a practical foundation for most investors' portfolios.